Alright everyone, welcome back to the channel. Today we're diving deep, and I mean deep, into something that the big players, the institutions, the guys moving markets, absolutely do not want you to know. We're talking about a strategy so potent, so consistently profitable, that it's practically kept under lock and key in the highest echelons of finance. I've spent countless hours, and let's just say, acquired some interesting information to bring this to you. This isn't your typical buy low, sell high advice. This is about understanding the mechanics of the market at a level that can genuinely transform your crypto trading game. We're peeling back the curtain on the 52-week high-low phenomenon and how it's exploited for massive gains. You see, the 52-week range isn't just a random data point on a chart. It's a psychological battlefield where fortunes are made and lost. Institutions have this down to a science, and they use it to engineer pumps, orchestrate dumps, and essentially play the retail market like a fiddle. But what if I told you that you could turn the tables? What if you could anticipate their moves, ride their waves, and even profit from their exits? That's exactly what we're going to break down. This isn't about gambling, it's about calculated precision, understanding market dynamics, and leveraging information that's typically reserved for the privileged few. Get ready, because this could fundamentally change how you view crypto investing. Yewo Stratgy Hijo Institutions Apko Kabi Nahi Batayenge. Mine Ek Hedge Fund Manager, Ki Laptop Hack, Kia our 52-week K Death Note Formula Chura, Lia. Aj Main Apko Dekanga Kaizi 52-week high-low co-surgical precision say use Cartagena 3 trades, 3 Lambos, like button Tadu Agar Apko Black Mirror style trading pass and high. This is the kind of information that can give you an unfair advantage, and today, I'm sharing it all. We're going to dissect 3 core strategies based on this 52-week secret. Strategies that have the potential for a 90% win rate if executed correctly. So grab a coffee, silence your notifications because class is in session. Alright, let's kick things off with the institutional pump strategy. This is probably one of the most common ways institutions leverage the 52-week high, and it's where a lot of retail traders get caught up in the hype, often entering way too late. So, what exactly is a 52-week high? Simply put, it's the highest price a particular cryptocurrency has reached in the preceding 52 weeks or 1 full year. This level is incredibly significant psychologically. When a crypto starts approaching this point, it garners a massive amount of attention, not just from retail traders, but more importantly from institutional desks. Institutions see a break of a 52-week high as a major bullish signal. It suggests strong momentum, positive sentiment, and the potential for a continued upward trend. Think about it. For an asset to break a year-long high, there has to be substantial buying pressure. This is where the FOMO, the fear of missing out, kicks in, even for big players. They don't want to be left behind if a major rally is starting. So when that 52-week high is decisively breached, you'll often see a surge of institutional capital flowing in, creating a powerful pump. This is the wave we want to catch, but not blindly. The mistake many retail traders make is jumping in the moment the price ticks above the old high. This can be risky because you might be buying at the very top of a short-term spike, or worse, falling into a bull trap where the price briefly breaks out only to reverse sharply. Institutions are smart. They often wait for confirmation or use sophisticated algorithms to enter. Our goal here is to be smart, not late. We don't want to chase the pump. We want to anticipate it and find a more calculated entry point, one that offers a better risk-to-reward ratio. So, how do we achieve this smart entry? First, we need to see a breakout above the 52-week high. This isn't just a tiny wick piercing the level, we're looking for a strong candle close above it, preferably on significant volume. That volume is key. It tells us there's real conviction behind the move, likely driven by institutional buying. A breakout on low volume is a red flag, suggesting the move might not have enough strength to continue. We need to see the big money participating to confirm the validity of this breakout. Once we have that confirmed breakout with strong volume, we don't just pile in. Patience is a virtue in trading, especially here. What we often look for next is a retest of the previous 52-week high, which now ideally acts as a new support level. The price might pull back slightly after the initial surge, touch that old resistance, now support, and then bounce. This retest and bounce provides a much safer entry point. It shows that the market is respecting the breakout level and that buyers are stepping in to defend it. This is where we can consider going long. Another crucial element is to look for confluence. Don't rely solely on the 52-week high breakout. Are other technical indicators also signaling a buy? For instance, is the Relative Strength Index, RSI, not excessively overbought, or is it showing a bullish divergence? Are moving averages aligning to support the upward trend? The more factors that line up, the higher the probability of a successful trade. This multifaceted approach helps filter out weaker signals and increases our confidence in the trade setup. Now let's flip the script and look at a scenario where the 52-week high can signal a potential reversal, specifically for a short trade. This is what I call the dark pool reversal. It's a bit more nuanced than the breakout strategy, but it can be incredibly profitable if you know what to look for. The key here is volume, or rather, the lack thereof, when a crypto approaches or touches its 52-week high. This is where understanding institutional behavior, particularly their exit strategies, becomes crucial. Imagine a cryptocurrency has been on a strong run and is now approaching its 52-week high. Everyone is getting excited, expecting a breakout. Retail traders might be piling in, anticipating another leg up. However, if the price reaches that critical 52-week high, or even slightly pierces it, but on or volume, this is a massive red flag. It suggests that the buying pressure is exhausted, and more importantly, that institutions might be quietly distributing their positions, selling into the retail buying frenzy. Why dark pool reversal? Dark pools are private exchanges where institutions can trade large blocks of shares or, in our case, crypto, without revealing their orders to the public market until after the trades are executed. While we can't directly see dark pool activity, a lack of volume on the public exchanges as a major resistance level, like the 52-week high, is approached can be an indirect sign that large sellers are absorbing buying interest without causing a panic, possibly using these off-exchange mechanisms or sophisticated selling algorithms. The psychology here is that institutions that bought lower down are now looking to take profits. They don't want to crash the price by dumping all their holdings at once on the open market. Instead, they try to sell gradually as the price rises, especially into strength or at key resistance levels where retail buyers are most enthusiastic. If the price hits the 52-week high and stalls, with volume drying up, it indicates that the demand isn't strong enough to overcome the supply coming from these profit-taking institutions. So, the setup for a dark pool reversal short trade involves identifying a cryptocurrency approaching its 52-week high. As it gets closer, we monitor the volume very carefully. If the price touches or slightly exceeds the high, but the volume on that move is significantly lower than the volume seen during the preceding rally, or if volume diminishes sharply as it hits the high, we start looking for signs of weakness. This divergence between price making a new high, or retesting an old one, and weakening volume is a classic bearish signal. Other confirmation signals we look for include bearish candlestick patterns at the high, like a doji, a shooting star, or an engulfing bearish candle. We also look for bearish divergences on oscillators like the RSI or MACD. For example, if the price makes a new high, but the RSI makes a lower high, it indicates that the momentum behind the upward move is fading. These signals, combined with the low volume at the 52-week high, strengthen the case for a potential reversal and a short entry. Once these conditions align, a short entry can be considered. The stop loss for this trade would typically be placed just above the recent high, giving the trade a little room to breathe but protecting you if the breakout eventually happens with renewed strength. The profit targets can be set at previous support levels on the way down, or by using Fibonacci retracement levels of the prior uptrend. This strategy is essentially betting that the institutional selling pressure will overwhelm the remaining retail buying interest, leading to a price decline. Alright, now let's talk about the flip side of the 52-week high, the 52-week low. This is where we find what I call the Satoshi retest scalp. And yes, this is the kind of trade that, when done right and scaled appropriately, can generate significant profits. It's no exaggeration that trades based on this principle contributed to my first Tesla. The 52-week low is often seen as a point of maximum pessimism, where everyone is bearish, and the news is typically terrible. But for savvy traders, it can present incredible buying opportunities, especially for quick scalps or even longer-term entries. The term Satoshi's trapdoor refers to the idea that the 52-week low can act like a hidden support level, a point where smart money, perhaps even whales who've been accumulating like Satoshi, might step in to defend the price or initiate new positions. When a crypto hits its lowest point in a year, it's often oversold, and the selling pressure might be nearing exhaustion. This is where we look for signs of a bounce, a retest of that low, and a potential sharp, albeit sometimes short-lived rally. The core idea behind the Satoshi retest scalp is to identify a cryptocurrency that has just hit or is very near its 52-week low. Unlike the breakout strategy where we look for strength, here we are initially looking for extreme weakness that might be overdone. However, we don't just blindly buy the moment it hits the low. That's like trying to catch a falling knife. Instead, we wait for signs that the selling pressure is abating and that buyers are starting to show interest. This often manifests as a retest of the low. What does a retest mean in this context? A crypto might hit its 52-week low, say at $10, It might then bounce slightly, perhaps to $10.50, before falling back down to retest the $10 level, or even slightly undercut it to, say, $9.90. This is the trapdoor part, shaking out weak hands. If the price then holds this level and starts to move up again, especially with some increase in buying volume, it suggests that the low is being defended. This successful retest and hold is our primary buy signal for the scalp. Volume is again a critical factor here. As the price approaches the 52-week low for the first or second time, we want to see if selling volume is diminishing. Now that we've covered these powerful 52-week high and low strategies, the institutional pump, the dark pool reversal, and the Satoshi retest, you might be thinking, Graham, this is great, but it sounds like a lot to keep track of. Volume, candlestick patterns, divergences, retests, and you'd be right. Manually analyzing all these factors for multiple cryptocurrencies can be time-consuming and frankly prone to human error or oversight. That's where the secret sauce comes in, something I've been working on with the brilliant minds at AMLFi Healthcare, the Amalfi Hybrid Indicator. Think of this indicator as giving you Terminator vision for the charts. It's designed to synthesize much of this complex analysis around the 52-week high-low levels and present it in a much more digestible and actionable way. We've essentially taken the core principles we've discussed, the institutional footprints, the volume anomalies, the momentum shifts, and programmed them into an algorithm that helps you spot these opportunities with greater clarity and speed. This isn't about replacing your judgment, but augmenting it, making you a more efficient and potentially more profitable trader. The AMLFi Hybrid Indicator isn't just another generic tool. It's specifically calibrated to work in conjunction with the 52-week high-low levels, which, as we've established, are incredibly significant psychological and technical zones in the market. It helps to automatically flag when a crypto is approaching these critical levels, and then provides additional layers of confirmation or warning signals based on a confluence of factors that we've built into its logic. This means less time staring at charts trying to piece everything together manually, and more time focusing on execution. For instance, when a crypto is nearing its 52-week high, the AMLFi Hybrid Indicator will be on high alert. If it detects a breakout attempt, it will analyze the accompanying volume. Is it strong, suggesting an institutional pump? Or is it weak, hinting at a potential dark pool reversal? The indicator can provide visual cues or alerts based on these conditions, helping you to quickly assess the situation. It might highlight periods of unusually low volume during an approach to the high or strong accumulation volume during a retest of a breakout. Similarly, when a cryptocurrency is plumbing the depths near its 52-week low, the indicator is designed to look for signs of capitulation and potential reversals like those we discussed in the Satoshi retest strategy. It can help identify bullish divergences that you might have missed, or pinpoint moments where selling volume is drying up and buying interest is starting to emerge. It essentially acts as an intelligent assistant, constantly scanning for the specific conditions that make these 52-week strategies so potent. One of the key features we've incorporated is a dynamic interpretation of volume. It's not just about whether volume is high or low, it's about how it compares to recent averages, how it behaves at critical price points, and whether it confirms or contradicts the price action. The AMLFi Hybrid Indicator uses a more sophisticated model for volume analysis than just looking at raw bars, giving you a deeper insight into the battle between buyers and sellers, especially around these pivotal 52-week markers. Furthermore, the indicator can help in setting more objective entry and exit points. While it won't tell you exactly buy here, sell there, because no indicator can predict the future with 100% certainty. It can provide zones of interest based on its algorithmic analysis. For example, it might highlight a high probability support zone after a 52-week high breakout and retest, or a potential resistance area where a dark pool reversal could initiate. This helps to remove some of the emotional guesswork from your trading decisions. The hybrid nature of the indicator means it combines elements of trend following, momentum analysis, and volume profiling, all specifically tailored to the context of 52-week extremes. It's not a one-trick pony. Okay, so we've talked about some incredibly powerful trading strategies and even a custom indicator to help you execute them. But how do we get this information out there? How do we make sure as many people as possible can benefit from understanding how institutions really play the crypto game? This is where we need to talk about viral triggers, and let's call them algorithm hacks. And yes, things can get a little controversial when you start sharing information that some powerful entities might prefer to keep quiet. Whispers leans into camera. Binance CEO named Mujhe Rokna Chaha, Parmainya strategy leak Cardi. Now, obviously I'm being a bit dramatic for effect here, but there's a kernel of truth. When you reveal strategies that level the playing field, that expose how the big fish operate, it can ruffle some feathers. The established players, the exchanges, the large funds, they thrive on information asymmetry. The less the average retail trader knows about their tactics, the easier it is for them to profit. So, sharing these kinds of 52-week secrets is, in a way, a disruptive act. The YouTube algorithm and social media algorithms in general love a few things: engagement, controversy to a degree, strong opinions, and value that keeps people watching. To make a video like this go viral, and to get these strategies into the hands of more traders, you need to hit those triggers. The title itself, Institutions Use This 52-Week Secret to Crush Crypto, 90% Win Rate, is designed to be a hook. It promises a secret, implies high success, and targets a pain point: being crushed by institutions. Another viral trigger is the US versus them narrative. By framing these strategies as tools to fight back against institutional manipulation, or to trade alongside them intelligently, it creates a sense of empowerment and camaraderie among retail traders. People are naturally drawn to David versus Goliath stories, and in the financial markets, retail often feels like David. Providing them with a better slingshot, so to speak, resonates deeply and encourages sharing. So there you have it, a deep dive into the 52-week high-low strategies that institutions use to their advantage, and how you, with the right approach and tools,